All right guys, have you ever heard the term rate buy down or maybe points? Today we're gonna be talking all about that, so hang in there and check this one out. What's up guys, my name is Ben Quann. I'm associate broker here in Virginia. Today I got my money man on who's gonna go into a little bit more in-depth on these rate buy downs or what they mean. I didn't know, we just had a client call us and she didn't understand what rate buy down, even after I tried to explain it a little bit, she still didn't understand the cost of it. So we figured, why not? We're already shooting our monthly market update. Let's go ahead and talk about rate buy downs and what that means.
Yeah, so it's honestly a very common question. I get it quite often, and it makes sense. It's not really a just well-known, put out there thing. It's you hear the term like, oh, buy a point or buy a point rate.
Yeah, and can I explain it? Like before rates went up, we never talked points.
Yeah.
Like you talk about like old timers, and they'd be like, oh, point here, point there, and I'm like, what are you talking about, man?
Yeah.
Been selling houses for 10 years, never even heard of it. No, I mean I did. But
yeah, when I was doing rates back in like 2020, 2019, whatever, like rates were so good, people would get credits back. Like you would get an overage on the rate. Like, hey, look, we're gonna give you an extra $200 towards closing because your points are so high. Like you can't overcharge a borrower. So yeah, it's just interesting how in the past year or so, 2 years, it's changed a lot. Where, like,
points have definitely came in there. Imagine like my rate's 2.85. What would I have been buying it down to? Like 1?
At some point you even couldn't. Like there's a lower limit where a bank, like, they're gonna give you 500 grand for 1%. You know, like it doesn't make sense. So there's almost a lower end where it doesn't make sense to even go lower, to buy lower. So yeah, basically, what is a rate buy down? So I'll start from the top. Rates are an open market every day, and it changes every couple hours. So at any moment, if someone goes, like the greatest question a lender always gets is like, hey, well, what are the rates at? Which is a huge question, a lot goes into that, but it can change. I can quote a rate in 10 a.m. in the morning, and then by 2 p.m. in the afternoon, the rates change a little bit. It's an open market depending on how the bonds are doing, and there's MBS market, and there's trading going on where it affects the rates. So what happens is on my end, I will pull the rates and I'll get a rate sheet, and it's broken down by lock time frame as well. So there's different programs, but also lock time. 15-day lock, 30-day lock, 45-day, 60-day. The longer your lock time frame, almost always, the little bit more it costs. You know, if you're locking for 120 days, and it costs a little bit more than if you're locking for 30 days. Most of your general locks in the purchase market is 30 days. That's like the general quote. Someone goes, hey, what's the rate? I'm gonna quote 30-day lock. Because most of your transactions are within 30 days. So that being said, what does it mean? So when I pull rates, I get, when something's priced at 100, that's our pricing. That is like no points paid. That is, you gotta be priced at 100. That is 100% value. If you go below 100, let's say 99.5 or 99 or 98, anything below 100, you have to pay points to get back to 100. That's how it's all working. So let's say you want to pay 1 point. 1 point is 1% of your loan amount. Then it gets you down to a 99 on my price sheet. So I can look at the 99s and go, hey, look, instead of on this price sheet, instead of a 7.25, it might be a 6.625. That's a VA loan. So you can see like, there's a pretty good savings on that 1 point. So you pay 1% of the loan amount, gets added to your closing costs. It drops your rate down from the 7.25 all the way down to a 6.625 on this rate sheet. So that's pretty good.
Likewise, like when you're going to buy your second home or investment home, now you're starting above 100, right?
Yeah.
So like, let's just give an example of when I bought my house, the secondary home or whatever, or investment, whatever you want to call it. I started like 102, right? I had to pay 2 points just to get to 100.
Yes, but here's how, so you're 100% correct, but how it reflects in the software, it's down in the LLPAs, it'll just have you at a certain pricing, like -2. So on the sheet, your like base rate will show 98. It won't show 100, it'll show 98 because you need 2 points just to get any rate. You know, like on this sheet, I have 100s, so I can just not have to charge any points. Like there is 100 that exists.
But the rates are already.
But on your sheet, it would look like that. It would just have a 98 at the very first, like an 8% would have like a 98 on it. So there was no 100. Like to get any rate, you had to pay 2.
Yeah, you had to pay 2, 3, 4 points sometimes for some of these secondary loans.
That's too big. If you're buying a second home or an investment property, the bank assumes there's more risk.
And there is more risk.
Yeah, you pay on your own home before you pay the investment property. So they
come hell or high water, I'm gonna make my own payment. If I got a second house somewhere else or investment property, worst case scenario, that gets taken back.
But the bank knows that, so that's why they charge a little bit higher rates. That's also why, to your point, this pricing differs based on your credit score, based on how much money you're putting down, what loan type you're putting in. So all those factors affect the price sheet. You know, if I pull rates on one individual based on what they're putting down and their credit score, what they have going on, that's going to be a different price sheet than if I plugged in Ben's information, whatever he has going on. So it changes. That's why there's no universal answer to, hey, what's the rate? It depends on.
And just to finish that investment, secondary home or whatever, that's why you have to put more money down versus like a 5% conventional on a primary. It's less risk, right?
Okay.
You're putting more risk, so they want to see you put more skin in the game, and that's why you start going into land, although land's going to be there forever, whatever, but or investment home or whatever. That's why usually you're starting at 15, 20, 25 and onwards for down payment.
If let's say you put 20% down on the loan, on the value of the, you know, so on the property, and then let's say you foreclose on it. Well, the bank has collateral, the asset, so they have to go in and sell that asset. So even if it does go down 15% or 10% because you foreclosed on it, you ruined it, you didn't take care of it, they're just assuming they'll at least recoup all their money because there's 20% equity in the home.
There's some equity in the home, and then you lose it, so that's your incentive not to get it foreclosed on.
Skin in the game and not lose it.
Yeah, for sure.
But no, that all makes sense. It all impacts what these points are. So to get back to the main point is points and fees are just, when you say 1 point or 2 points, that's just a percentage of the loan amount. You can pay 1.5, 1.25, you can pay all kinds of decimals, 1.35, you can pay any sort of points. Now there is an upper limit. Most loan types do require, like there's a points and fees test, and that gets kind of complicated, but there is a limit on how many points you can pay.
No, so it's not just unlimited.
Yeah, you can't just pay like 1 million points. So there's a points and fees test depending on if it's conventional, if it's FHA, that's a whole other subject. But by and large, most borrowers don't pay any more than two and a half. Like that's like your upper end of like how much your points being paid.
That's funny. We have a lender that texts us or whatever. Another good buddy of mine. But he was like talking about how the rates were better or whatever. I was like, call me when they're 2.85. And he said, I can do that for 22 points. But no, it's not going to work.
22% will, it'd be like 80 grand. It only makes sense if it saves enough money. The one factor we talked about prior to this is, let's say right now you're buying a home and you want to put down, let's say you want to pay a point to buy the rate down, from a 7 to a 6.5. If you think you're going to refi in the next 2 or 3 years, if you believe that rates are going to be 5 or 5.5 or 4, you may not want to pay points.
Yeah, so that's the tricky part, and that's the one that everybody's going to ask you for your crystal ball, and this is where you have to kind of go off your own judgment at this point, just like buying stocks or whatever. Because if you only plan on living in that house for a year, which is not a smart idea with this how volatile this market is anymore, but if you're only living there for a year, it's like, is that $4,000 to buy that point or whatever? Is it going to equal out to where you're going to save $5,000 or even $4,000 is the cost of the point over those mortgage payments? Again, if you're planning on leaving it, or like in our environment right now, we're really hoping these rates are going to come down. So if you, let's say today like 7.35 and you buy down to 7, are we hoping that the rates are going to be better in 2 years?
Yeah, because if you refi in 2 years, let's say down to a 5.5, then you didn't really need to pay any points to buy down from a 7.5 to a 7. You might save a little bit. That let's say the math is $50 a month, and you can math it all out, and hey, did that add up to enough savings to pay whatever the loan amount is? But that's where a professional like myself, and you do the math as well, but just to break it all down, like I make sure when I'm working with somebody that it makes sense for you. Like I don't want you just to pay a point for no reason.
And that's why I've honestly partnered with you. I mean, I like you as a person.
But also not like.
But you're just like, you're gonna give a lot more insight than your average lender out there that's only worried about just locking loans and keep going.
That's always my goal is like I want to be.
Well, I'm assuming it comes across too in these videos when we do market 100%. Updates and whatnot.
No, and that's the whole thing is like I will, you want to take care of the person. Like you don't want to just like, hey, throw it out there, pay a point, who cares? Like make sure it makes sense, make sure it's saving you money, do right by somebody. And that way hey, my goal too is one, take care of you because that's a good thing to do, but also you can tell your friends and family, hey, look, this guy's a good person, he's gonna take care of you. That's the whole goal.
Yeah, right. Right.
So that's points and fees.
Did we ever talk about like the actual what it costs? 1 point.
Yeah. So like when you say 1 point, that's 1% of loan amount. And
Just to break that down further.
Yeah, so it's loan amount though, and not purchase price. So if you're buying a home for 400, but you're putting 20% down, that's going to affect the point, and the point's going to be lower, which is good.
Oh, that's a good point too. I didn't think about
Some
that.
people think like the purchase price, like, oh, well, I'm buying a home for 400,000, so the points want $4,000. Well, no, it's not. If you put down 30% or 40%, whatever it is, it's 1% of the loan amount.
Ah, that's a good point. That's a good point. So again, but VA, you're not putting down, just for easy math, 1%. I feel like that should be pretty easy,
it's
but
interesting because like usually the funding fee will get rolled into the loan, so it's actually a little bit higher than purchase price.
yeah. So that's like at 400, it might be like 405 or whatever, 410.
So it's $4,100 instead of $400.
Yeah. There you go. So 4,000, 4,100, something like that, depending on again that.
The good
fee.
news too is it gets rolled into your closing cost, and you know you just pay the closing. So it has to make sense. The cash basically you're paying towards that rate has to make sense in the long term.
And that's where, like, you know, these 2-1 buy downs come into somewhat of an effect. It's like if you can afford it and you can just get some icing on the cake and get cheaper rate for 2 years.
I have not been a big proponent of 2-1 buy down.
No, you've never talked about it, right?
I don't really like them. I think they don't make too much financial sense. Now, the selling point of the 2-1 buy down was, hey, it costs points, by the way. All these 2-1 buy, unless it's like a well, either way it does. Because let's say a builder or a lender you're working with has like a, hey, we have a special on 2-1 buy down. You know, it's going to cost them points. They could parlay that into just buying your rate down, like just buying the base rate down, a fixed rate. But the reason is, let's say a 2-1 buy down is like the rate, let's say is 2% cheaper in the first year, 1% cheaper the next year, and then it's the par rate in the third year, whatever that normal rate would be. Well, you could just take the normal rate instead, if it costs you 2 or 3 points for that 2-1 buy down, and just buy down your rate for the 30-year fixed, right? Now the selling point of the 2-1 buy down was, hey, on that third year, you're just going to refi anyways, and now you had cheaper payments for 2 or 3 years than you refi. Okay, there might be some wiggle room there, but by the way, if in the 2 years prior to this, you did a 2-1 buy down, or a year ago you did a 2-1 buy down, you're so far in the losing end of that deal, because you could have just bought down your rate at the time would have been like 5.5 and bought it down like a 4.75, or bought a 6 down to a 5 for those points and just got a 5 permanently.
Because it is quite expensive, right?
Oh yeah, 2-1
it's
buy
like
down
2%.
Like 2 or 3, 4%. It could be like 2 or 3, 4 points for 2-1 buy down.
Wow.
And you know, so that being said, if you in an interest rate environment that's going up, you would rather just have a cheaper 30-year fixed rate. Like you could have bought down a 5.5 a year and a half ago or so, or a year ago, to a 4.75, and then you're good for the next who knows how long. We might not see a 4.75 for the next 2-3 years, who knows. So in an environment where rates are going up, you don't want a 2-1 buy down. Yeah, like,
crystal ball.
So, it's, you know, it depends, but in my opinion, I'm not the biggest fan of 2-1 buy downs. I do think you should just buy down the rate at a 30-year fix. If you could pay 6 points, you'd be down to 5.5 right now.
Oh wow.
Which is great. But
6 points.
That's 6%.
And what's this loan on?
Let's say it's listed for $475. $28,500.
$28,000 to get a 5% loan. Is it worth it?
Yeah, that's
Do you have FU money?
At that point, I don't know.
You shouldn't be proud.
How much could you just put down more in your loan, or like that's a tough one. But and then here's what sucks: if you paid $28,000 to buy your down to 5.5, and then rates just got to 5.5 in the next 2 years,
You would have to make up some serious ground
you could
to
have
make
just
sense.
refinanced and paid. I don't know. Refinances cost money, by the way. You know, so it could cost you.
That's a good
$5,000
point.
or $7,000. But you know, a refinance for $7,000 is a lot cheaper than paying $28,000.
Yeah.
So rates improving and refinancing later is always cheaper usually than paying a bunch of points. That's why I almost never recommend paying any more than 1.5 or 2 points. Like that's a reasonable cost that continually.
Right.
Yeah.
So anyway, guys, I hope this helps. I hope this makes sense to everybody. Of course it does to us because we're in it daily, but I was taken back a little bit when someone didn't know what a point was, didn't know rate buy down at all. But again, I sold them a house in 17, and like these weren't questions. They weren't a thing.
Yeah.
They weren't a thing. She just asked me, of course I'm not going to disclose the name, but she just asked me, would it make sense to refinance and roll our HELOC? And the question would be absolutely not. Because if they bought in 17, they have a much better rate than anything we can get today. So refinancing, refinancing right now, if you bought and you have a low rate, it just doesn't make sense.
Very few cases. If for some reason you had a ton of equity and some other opportunity to take cash out to go do something with it, but even then you're gonna pay a much higher rate. It's gonna suck.
Yeah, I mean, so the goal would be like a HELOC.
Yeah,
if you had to pull a little bit out and you're gonna plan on paying it back pretty quick, that would be one thing. Yeah. But just because you built all this equity in your house and you're trying to reach it now, financially, it doesn't make sense to refinance and pull that equity
That's
out.
A good point. I mean, the HELOC maybe that makes sense. You pay it back.
I'll give you a prime example. We bought a lot. and we pulled out a HELOC to buy that lot because I figured within a year we'll have a build on it.
Yeah.
And I'll sell it and I'll pay my HELOC back.
And that makes sense.
Rates were like 12%.
Because if you refinance, you're refinancing to a new 30-year fixed rate that is set. You know, at least the HELOC you can pay it off, pay it back.
That's right.
So.
All right, guys.
All right, guys. We'll see you next one.
I hope this helps. We'll see you on the next one.